Hello, welcome back. Today we're taking a look at a Canadian stock. It's called Cineplex, is the company, and it was suggested by one of our subscribers. Interesting one. There's gonna be another Canadian stock coming up shortly, but this one is, as you can understand, it's the communication services and entertainment, pretty much sector and industry. It's operating an entertainment and media company in four segments. It's in Canada, and it's an IPO that was actually held in 2003. Look at this beta. This is 3.21. This means that the company is actually very volatile in terms of its stock price. And we're going to be taking a look, as we usually do, at the financials of the company and see whether this kind of Canadian company actually makes sense to purchase. Now, I did make a video yesterday, really, and I was talking about the different exchanges. This is the Toronto Stock Exchange, TSX. And when you compare it to the S&P 500 and how it has been trading over the years, you will see that it has made about half the profit that the S&P 500 has made. So the S&P 500 made about 901%, I think it was, and the TSX was half that. So you have to bear that in mind that US companies could potentially move faster and do more profit over the years. Now, there is also a different argument here. One could say that the Canadian Stock Exchange hasn't gone up that much, so it has more room to grow. Yes, but it's also a smaller economy, and so you have to bear that in mind and kind of see what's been happening in the past. Because it could it could do better, but it could also do worse or just trade sideways. So typically, I like to go with in the path of least resistance, which tends to be US stocks, Chinese stocks, and maybe Germany stocks. Okay, so we're gonna take a look at what the company is doing. Let's take a look at the max chart. Look at this, for instance. Like the company was actually at its IPO days was trading more than what it's trading now. So it used to be 20 Canadian dollars hereabout when it had its IPO days. This is actually not in the IPO days. This is 2010. And right now it's trading at 12.88, almost $13. So it's down. So if you bought it like 20 years ago, you're down. That's 10 years ago, 12 years ago, something of that sort. You're actually down today. So yeah, this is why you need to be very, very careful. Now, this may be an interesting opportunity though, because it's down. So we will examine what the company is doing financially to see whether that's the case. Now we start here with the P/E ratio of the company, which is negative, meaning that the company is losing money right now, losing income. And the price to free cash flow ratio is positive, while the price to earnings ratio is negative. That's a concerning sign. Typically means that there is some sort of expense added back as cash here. We're going to examine it. Now the outstanding shares is lower, but about the same, practically speaking. It's a very, very small difference, 0.2%. This is good. Look at this. The free cash flow to total liabilities is 83. Wow, that's a lot of liabilities compared to the free cash flow that the company is making. 83 years required to pay. That's 83 years of last year's free cash flow to pay all the total liabilities that the company has. And that's not to say that we want to do that, but we want to have a measure of how many liabilities we have. We will examine that in detail. 5-year revenue growth going down, and 5-year net income growth also going down. 5-year free cash flow growth going up. Again, that's probably some sort of a cooking in terms of the numbers. We're going to examine it. And total equity growth, as you can understand, it's going down. You would expect that. Now, of course, this is an entertainment company that I'm pretty sure has been bust during the pandemic. And so this is something to take into account when we're examining what's happening here. And the other net income margins have completely been annihilated lately. They used to be close to zero though. And the debt to equity ratio is negative because they have negative equity here. So yeah, the numbers are not really looking great, as you'll see. But let's actually take a look. This is a company that we need to take a look at what is going on exactly at their financials, with their financials, because they were hit by the pandemic unavoidably, and you would understand that. So over here, they were doing much, much better. So this may be a play that you can make and expect for it to do better in the next few years, because we are exiting the pandemic, hopefully. And so you will see here that the company had marginal net income over here, very little net income, but positive. But now they have lost quite some. They have lost a lot of money compared to what they were doing in the previous years. Okay, so their balance sheet must have gone in the negative because of that. and you will see it here. Their actual total equity used to be positive, and then the pandemic happened, and they went negative over here, as you will see. And their total liabilities is at $1.8 billion, which tells me that the free cash flow is going to be very, very low. That's because we required about 83 years. So if you do the division, you can actually see how much it will be. Let's take a look at it now, because this is very, very interesting here. They have negative net income but positive operating activities cash flow, and that's because of depreciation and amortization. I was kind of expecting that. Some change in working capital as well. That is a one-time thing for the most part. It's there is some sort of a change in some of the capital of the company, which is not a cash change, and this is why it's added back in the operating activities cash flow. And over here, the cash from investing activities is positive because I'm assuming they have to sell some stuff in the other investing activities. They are probably selling some investments here, and the financing activities here, they are negative in the past year because they repaid some debt. Not much movement going on, a little bit of debt, a little bit of extra debt over here and also here. So the past couple of years they had to take on some debt. That makes sense. Very little cash within the company. And slightly positive free cash flow, but we did examine why. This is 22. Remember, this is 22.3 million in terms of free cash flow, and the total liabilities were what, like 1.8 billion, I believe. Let's take a look at it again. 1.8 billion. So that's massive compared to what kind of free cash flow they are making. That's a pretty big concern for me. And the problem I'm having with this company is not so much the pandemic years, but the fact that they have amassed a large amount of liabilities here, and they are not making good enough free cash flow. So even before that, like look at this, in 2017, they had actually negative free cash flow in 2017, and also 18 and 19 were not that impressive either. 19 was better, much better, but still would take many years to just to get enough free cash flow to to make sense for the liabilities that the company has. Okay, so let's now take a look at the stock evaluation tool and see whether there's a price to pay for this one over here. Of course, I cannot really be using the last couple of years just because the company was in the pandemic and the numbers have been massively skewed because of that. So I'm gonna be, for the most part, relying on what the company was doing earlier. So in these years, maybe this couple of years, and as we're exiting the pandemic, you would expect this to grow much faster. But this is not indicative, of course, because there's the booming. This is much more indicative, maybe a little bit more than this, because we're talking about the next 5 years. So I will go 5, 6, and 7, which I think that the company can achieve in the next 5 years because they have dropped a lot. So I think they will be achieving that, maybe a little bit more even. So yeah, let's just say we go with this one for now. And the net income margins, they're very low. So we're gonna go, let's go 3, 4, and 5 here. And the free cash flow margins, I'm gonna go with something which is more typical. This is more typical, the kinda close to normal. So I'm gonna go 90, 100, and 110. And the annual return is going to be 13%, is what I typically like to make from single stock investments. This is one that I could even ask for more. It's a little bit risky here. Let's hit calculate, and you will see that we are sitting a little bit far from the current price. And if we up our projections and say that we're expecting the company to grow more because it's exiting the pandemic, let's just say we go a little bit overboard here and even expect an 18% growth, even then our current price is elevated compared to what we would like to get it for. Now, as you can understand, this kind of company can have a little bit of explosive growth because it's exiting the pandemic, but it does have its risks. So if you are potentially willing to play it for a cyclical type nature company because it's exiting the pandemic, exiting this kind of bearish cycle, then I would probably suggest to try to get this company at around $4 maybe. This is when you would see some interesting potential growth, and it would probably be deserved of the risk. Maybe 5, but at this current price, 12.88, I think it's very expensive for what it is, and I probably wouldn't approach it for buying purposes. And yeah, I think it's a little bit expensive and too risky for what it is right now at that price. Now, if it goes down more, if it keeps going down, Let's take a look again at the stock analysis chart just to see what the current trend was. So we'll examine like the 1 month one. I don't think I clicked that actually. I'm not sure why that's not loading. Yeah, it looks like I had some sort of an issue with my internet connection here. Let's check it again. Interesting. It looks like this for this company the stock analysis API takes a little bit of extra time. I'm not sure why. That's very rare. But okay, the 1 month chart, as you'll see here, has been trading sideways and it's going a little bit down here. So we could potentially expect to see a little bit of an extra drop here. What was their lowest price? Let me examine the last, let's take a look at the 3-year chart. It used to be 7 here, 6.62. This would be a good price actually to buy that. But yeah, right now I think it may be a little bit too much. Okay. So thank you for watching the video. I hope you enjoyed and it helped you a little bit. Interesting suggestion. It always pays to at least take a look at Canadian stocks for sure. And there's gonna be another one coming, and I may be making some videos about German stocks as well. This may be interesting too. So thank you for watching this one, and if you did like, please leave a like and remember to subscribe. At some point I will give you access to this too. You want to be around when that happens. And thank you for watching, and remember to also take a look at this video that I made earlier, and in this one I'm discussing Alibaba and what's currently happening within the company, and the stock price of course, and the stock. So thank you for watching, and I'll see you in the very next one. Bye bye.